Welcome back to Talk Tickers. We're here to give you the narrative, not just the numbers, from the latest earnings calls.
And today we are doing a deep dive into GRDN Pharmacy Services. That's ticker GRDN. They just dropped their Q3 2025 results.
And this is a really important one. I mean, this quarter basically wraps up their first full year on the public market since that IPO.
The question was, is the execution matching the market enthusiasm? We needed to see if that growth story was real.
So our mission today, filter through the management talk, the operational details, and really answer, did they keep that momentum going?
And the short answer is yes. They absolutely delivered. The main takeaway here is just a decisive beat on both the top and bottom lines.
But the revenue beat was the real shocker, wasn't it?
Oh, for sure. That's what really opened everyone's eyes.
Okay, so let's put some numbers on that. The adjusted EPS, that came in at, what, 25 cents?
25 cents, yeah. Which, just squeaked by the 24-cent consensus. That wasn't the headline.
Right, the headline was the revenue.
The revenue was $377.4 million. The street was looking for $354 million. That is a significant beat.
Wow, and that's 20% growth year over year.
20%. It really signals they are grabbing market share in what's a very fragmented long-term care pharmacy space.
And a gap that big between expectation and reality, that gets noticed fast.
It does. The stock immediately climbed about 3.3% in after-hours trading.
Which tells you that investors saw something new, something that wasn't already baked into the price, even with the run-up it's had.
It shows real confidence. And that leads right into the next critical point, which is the profitability story. This quarter was a massive inflection point.
An inflection point because they're finally getting past all the noise from the IPO, right?
Exactly. I mean, if you look back to this time last year, the GAAP loss was deep. But that was mostly due to, non-cash charges and restructuring stuff around the IPO.
So how big was that swing?
The GAAP numbers tell it all. They went from a loss of $2 a share a year ago to a profit of 15 cents a share this quarter.
That is a dramatic reversal.
It's huge. In actual dollars, it's a net income of $9.6 million, turning around get this, $105.8 million loss from the prior year.
So that's the proof right there that the business model is working post-IPO.
It's the definition of it. They're cleaning up the books and showing the real profit potential underneath.
Okay, so if that's the inflection point, let's talk about the engines. What did management say was actually driving that 20% growth?
It was a nice blend of organic growth and, of course, M&A.
So more people using their services?
Right. The total resident count was up 13% year over year, hitting just over 203,000. And management actually pointed to 3 specific things that gave them some extra upside this quarter.
Interesting. What were they?
Okay, so first, new residents from their facility partners got onboarded earlier in the quarter than they planned, so they got a full 3 months of revenue from them.
Okay, that makes sense.
Second, their plan optimization efforts, which is basically just getting more efficient with existing customers, that paid off. And third, vaccine season started a bit earlier this year, pulling some of that revenue into Q3.
So just solid execution across the board.
Just really solid.
All right, let's get into the more complex part of this model, the margins. Adjusted EBITDA was up 19%, which is great, but the margin itself was 7.2%, kind of stable, not really expanding, so...
Why not? This is the absolute core of the GRDN investment story. And to their credit, management was super clear about it.
Okay.
That 7.2% margin is being held down on purpose by their M&A strategy.
Meaning they're buying businesses that are less profitable to start with, and that pulls the average down.
Exactly right. They said, look, our recent acquisitions and our new greenfield startups, they dilute the overall margin in the short term, and they even quantified it.
Well, they gave a number.
They did. They said their core, their mature, established pharmacies are operating closer to an 8% margin.
That is a crucial piece of information. So that 7.2% is actually hiding improvement in the core business.
It is, but here's the tension. They said it takes about 4 years for a new acquisition to ramp up to that corporate margin level.
And they plan to keep acquiring. So for investors, does that just mean we should expect flat margins forever?
That's the multi-million-dollar question, isn't it? You're always going to have this drag. The bet is that their platform can integrate these new pharmacies so efficiently that the savings in the mature business eventually outpace the dilution from the new ones. But yeah, it's a multi-year story.
Okay, great context. Now, what about the foundation for all this? The balance sheet, it looks a lot healthier now.
A lot healthier. Their focus on generating cash is really working. Operating cash flow for the first 9 months of the year nearly doubled, hitting almost $66 million.
And their debt.
They ended the quarter with $36 million in cash and, importantly, zero debt drawn on their credit facility. Their cash conversion is tracking above 60%, which is, a very healthy sign.
So, solid financials. Let's pivot to the strategy, the playbook. It's this local density plus M&A model.
Yeah, and the CEO, Fred Burke, he had this great quote. He said, Guardian was built pharmacy by pharmacy, relationship by relationship.
Which tells you this isn't some top-down corporate play. It's about winning on the ground locally.
Totally. It's a relationship business first. And they use M&A to then scale that local success nationally. Q3 really benefited from deals they integrated in the Pacific Northwest, Oregon, and Washington, plus earlier ones in Kansas, Ohio, and Florida.
And these deals are pretty strategic, right? They're not just buying anything.
Not at all. They often buy a pharmacy because one of their big national customer partners needs coverage in that specific area. Management said the M&A pipeline is still very full for 26 and 27, but they're disciplined. They want the right local operator, not just the cheapest one.
And all of this is happening against a backdrop of some pretty powerful demographic tailwinds.
Oh, absolutely. The aging population, higher acuity needs, LTC facilities filling back up. GRDN is just perfectly positioned to consolidate a very fragmented industry.
Okay, that's the bull case. But the call wasn't all sunshine. They were also pretty upfront about the risks, specifically policy risks.
Yeah, they flagged two big ones, drug pricing reforms like the Inflation Reduction Act, the IRA, and then the ongoing fights with payer reimbursement.
Can you just quickly break down the IRA risk for anyone who isn't deep in healthcare policy? How does that actually affect Guardian's business?
Sure. So the IRA puts a lot of price pressure on prescription drugs, especially for pharmacies that serve Medicare patients, which is a huge part of Guardian's business.
Okay.
The full impact is still rolling out, but the industry expects it to be a real headwind to EBITDA starting in 2026. Management said they have a plan to offset it, but they also warned that because of these policy changes, reported revenue growth next year could look, and this is their word, relatively flat.
Wow, okay, that's a big warning. And the other risk, dealing with the PBMs.
Right. The pharmacy benefit managers. They're the middlemen who process all the claims. In the Q&A, analysts asked if they were moving to more modern, value-based payment models.
And the answer was?
Management described the pace of change as glacial.
Glacial pace. That says it all, doesn't it?
It really does. It tells you the fight is still about dispensing fees and spreads, not some innovative new model. The risk there is structural, and it's not going away.
Before we get to the market signals, they did file something about their capital structure, an S3 shelf registration.
Yeah, for 6 million shares, it's really just a preparatory move. It gives them the flexibility to raise money quickly if, say, a big acquisition opportunity comes up. It's not an offering right now.
Okay, and more importantly, they talked about the lockup period for existing shareholders.
Yes, and this is key. They confirmed that 93% of the pre-IPO shares are locked up until June 2026. That's huge because it calms fears of a massive flood of stock hitting the market and tanking the price.
So, strong foundation, working strategy, known risks, all that confidence led them to raise their full-year guidance pretty decisively.
That was the big catalyst after the call. They bumped up the full-year revenue forecast to between $1.43 and $1.45 billion.
And the EBITDA.
Lifted that significantly to a range of $104 to $106 million. The midpoint there implies a really strong 16% year-over-year growth.
And the stock has just been on a tear, reflecting that story. It's up, 47% year-to-date?
About 47%, yeah. Just crushing the S&P 500, which is up around 14%.
But that great performance leads to the big debate, right? The valuation tension.
Mm-hmm. It definitely looks expensive on some metrics. It's trading at around 1.4 times price to sales. For a value investor, that might suggest all the good news is already priced in.
So is the growth story good enough to justify that premium?
That is the debate. The bulls and management would argue yes, because this is just the beginning of a decades-long consolidation story. You're paying for that long runway.
And the market, at least right after the call, definitely sided with the bulls.
No question. The stock hit an all-time high of $31.79 the next day, and it was on really high volume, sometimes double the normal activity.
Which probably means big institutional money was moving in.
It suggests that, yeah. And you also had a bit of a short squeeze dynamic. Short interest had jumped 58% in September. So when you get a big beat like this, those shorts have to scramble to cover their positions, which just pushes the stock even higher.
A perfect storm for the stock price. Okay, let's pivot. And just as a necessary reminder, what we're about to discuss is for entertainment and discussion purposes only. This is not financial advice.
Absolutely. So you have this clear operational strength, but you also have this persistent policy risk hanging over everything, the IRA, the PBMs. That split sets up a pretty interesting tactical trade,
Okay, so the goal here would be to ride the short-term momentum from the earnings beat.
while also insuring yourself against that big structural risk, especially with management already warning about 2026.
So what's action number one?
Action one is a straightforward part. Go long GRDN stock.
Yeah.
You're betting on that post-earnings momentum, on the analyst price target hikes. Truist raised theirs to around $34 and on continued execution.
And then the hedge. This is the key part. Acknowledging that 1.4 times sales is pricey and that 2026 could get rocky.
Exactly. So the hedge is to buy some insurance. You use a small amount of capital to purchase out-of-the-money put options.
And you'd want those to be further out expiration-wise.
Yeah, you'd look maybe 6 to 9 months out. That gives you time to get through the next few quarters and past when they'll release their formal 2026 guidance. It lets you capture the upside now, but protects you if there's a policy-driven panic later.
It's a classic play. Capitalize on the execution, but hedge the regulatory risk. So, to wrap up our deep dive, Guardian is past its IPO issues, the M&A strategy is working and driving growth, but those policy headwinds are real and they are coming.
And for you, the long-term thinker, the real test isn't just can they grow volume. It's can they, over many years, actually expand that adjusted EBITDA margin past 7.2%? Can the platform's efficiency finally outrun the constant drag from all the new dilutive deals they keep doing?
That tension between aggressive growth and the margin profile, that's going to define this stock story in 2026 and beyond. That's really the question to mull over.
Indeed. We'd encourage you to go dig into the materials yourself.
Thanks for joining us for this deep dive on Guardian Pharmacy Services. We will catch you on the next one.